joining in and say my hi to Ajay. It has been long that I have not spoken to him, so thanks a lot, Mahesh. Okay, so uh, why do we need financial modeling, and why it is important in today's world? More important in today's world. Look, financial modeling. Whenever you do projection, whenever you do budgeting, whenever you do valuation, you need financial models, right? You need projections. You need how your sales will look like, how your gross profit will look like, how your EBITDA will look like, right? What will be your valuation? All these deals which are happening, geo and all that, somewhere financial modeling plays an important role. Financial modeling and valuation. So I keep these two terms very separate because valuation is more of an art. Financial modeling is more of a science. Yeah. So this is how it works, right? Financial modeling. So we will keep moving on this. Okay. So why do we need financial models? Why do we need financial models? We need financial models for corporate decision making, right? Strategic planning, etc. We need whether we want to invest in a project, we need a financial modeling when we do project finance, corporate transactions, merger acquisitions, capital raising, we do financial modeling, and investment decision, whether you want to invest in a particular company or not, what will be the valuation in future if you invest, whether there will be equity accretion or dilution. All these things you take care in that. Okay. In corporate decision making, you do a lot of scenario analysis and sensitivity analysis in corporate decision making, right? So this is the spectrum, this is the length in which the financial models helps us. Okay. Now moving forward, what kind of financial models do we build? Okay, so you have different kind of financial model: a three statement financial model, a DCF model, a scenario analysis, a sensitivity analysis, merger and acquisition analysis, capital raising, and on the top it is LBO. So for reaching to LBO, you need to make this and then come to LBO level, right? It becomes more and more specific as you move downwards. Like for DCF, the basic premise is that you have made a three statement model. Then you come to DCF. Then you do scenario and sensitivity analysis, right? Then merger acquisition, capital raising, and LBO decision. So the point is, for any financial model, what you have to do is you will have to prepare the profit and loss account, balance sheet, and cash flow statement with projections for, let's say, next 5 years or so. And then you do multiple calculations on it to make it meaningful. From numbers, you make story out of numbers. Getting my point? So this is what a hierarchy of financial models is. Okay. Now, as you understand, this is only a 1 day program which we have launched. We will only cover this DCF analysis. Okay. So we will take a base statement and prepare a DCF analysis. Some of the formulas, etc., we will use. But I may, if time permits, I may show you how a scenario analysis looks, a sensitivity analysis looks like. Okay, quite interesting. So that you can, basis your interest, you may think of building your knowledge in this field. Yeah. So now we will come to some of the basics of making a financial model. Okay, so financial models, okay, has to be made in a very neat and clean fashion. The flow has to be very clear. Okay, so the inputs has to be very clear, because as I said, valuation, when you talk about valuation, it has lot of elements of art, and I will come to that. But when it comes to financial modeling, it is science. So that means what? You can use templates and can modify the templates as per your need and start building good financial models on that, right? So first is inputs, where you get the assumptions and the base figures. Let's say you have to build a profit and loss account, three statement profit and loss account. What do you need to build a three statement projected profit and loss account, right? So you will need historical data, number one. Number two, what you will need, certain assumptions, how much my revenue will grow, how much my cost will grow, how much I'm investing in capital, how much I'm borrowing money or taking funds from equity investors. These are all the assumptions which you take in, okay, and then build the three statement model, right? So how much is the sales revenue growth is one question which has to be dealt with separately. But once you get into that number, that first year the growth will be 10%, second 12, third 15 or so. This is the projections, etc. You will take it and build it in your model. So you have to be very, distinguish your work with the work of the input. That doesn't mean I'm not saying that close your mind and take the numbers. You have to logically test. But if you start questioning that 10% growth of revenue or 12% growth of revenue, then what will happen? You are questioning, you are stepping in the business shoes, which any which ways you will have to do, but the mindset would be different. So today, rather than art, we are working more on the science front of the financial model. Getting my point? So guys, please, stop me whenever you feel like, and there are on the bottom of your chat box, you have yes, no, go fast, go slow. So I will adjust my speed according to that. Yeah. Okay. So these are the kind of things which you look at in the financial model, right? Okay. So process, and then you have outputs. Now outputs is very, very important. You can't give outputs in the form of a balance sheet or a P&L. You will have to process it and give only some 2-3 KPIs. That KPIs also you should give it in the form of charts and graphs, not in the form of lengthy numbers, which is there in your Excel sheet, right? The point is you will have to cut down your boss's efforts if you want to grow in any organization or you want to grow in your business. So there is a saying that if I have to write a letter of 4 pages, it will be faster for me to write rather than if I want to write a letter, okay, or pointers which are only like 1 or 2 paragraphs long, right? So giving lengthy things is very easy. Similarly, making a PPT of a 50 slide is very easy, but making a very precise pitch pack of 8 slides precisely, plus thank you and your first slide, 10 slides PPT is that much more difficult. It takes humongous amount of effort. So what I'm trying to say is all your numbers, all your detailing should come down, should boil down to only few numbers, and we will see how we will make all these things. Okay. Now, what are the best practices of models? You will have to, you should test this model. The model should be simple and clear. That is one of the very, specific ask of the modeling. Okay. And plan how you will input the model, how you will take the model in, take the inputs into your model. That is also very, very important. Look, when we work on Excel, no, we often don't take care of these small things. But when you do something as niche as financial modeling, you have to be very neatly, you should organize your file very, very neatly. That by just a look and feel of your file, someone is able to understand what you are trying to articulate. Getting my point? Also, you should use conditional formatting very, very judicially. Like, for example, in all my financial models, all blue numbers, all blue fonts are hard punch number, all black are formula driven numbers. So you can come to know that where it is blue and where it is black, where it is hard punched and where it is formula driven, right? So it gives you a very good flavor on the integrity of your model which you are building. Getting my point? So you have to be very, very conscious if you want to work on financial model. So guys, Karthik is saying that it is not visible. Is it visible to everyone? No, Excel I have not started only. Um, this is only the PPT I am sharing. Na? Yeah. Excel I will go to Excel file, right? Now, models, when you do financial modeling, sometimes what happens is when you learn financial modeling and when you reach a particular level, you want to make it as detailed as possible. Okay? You make it lot of complex formulas, lot of complex VLOOKUP, XLOOKUP, HLOOKUP functions, all that you will try to build in that. Okay? But a complex model is not appreciated in this field. Okay? A complex formula are not appreciated. Simple but effective formulas is what is required. Okay? So that is what it is. Neither your financial models should be very, very simple. That cost plus 10%, sales plus 10% is my revenue, and accordingly my profit will grow 10%, my taxes will grow, everything will be 10%. Okay? Where this number has come from, no one knows. So it cannot be so simple also. But you will have to find a sweet spot for financial modeling where it is detailed enough, where it factors all the complications of the business, but does not make your model complicated, right? You will have to make your model very, very simple and succinct, right? So what you have in a financial modeling, you have assumptions and drivers, which is the historical ratio. So we will take financial modeling class. A couple of days we go in brushing up our concepts on ratios so that we understand the ratios very, very clearly. So since today we want to focus on DCF, I will cover some of the key aspects so that you can understand the DCF model well, right? But you need to understand the ratios. You need to, like what we have done in our CA classes is something different, right? In CA, we have just understood to pass the exams. Here, you will have to read those ratios. What does each ratio mean to you? What is the meaning of that ratio? So, ratios is very, very important. Then, income statement, summarized income statement, balance sheet, and cash flow. All these things you will have to prepare along with the supporting schedule. So, it has to be very, very detailed also, right? In the forecasting thing, because after doing forecasting is that you will be doing DCF model, right? So what do you do? The steps: you take historical data, you take assumptions and drivers, you forecast the revenue down to EBITDA, then forecast working capital, forecast capital asset, capital structure, and complete the cash flow. These are the steps for what? Building a 3-step model. For today, this work is already done, and I will just take you through that work so that you are in. But there are a lot of steps which are involved in making the 3-step model, right? So, and like forecasting methods, there are different kind of methods of forecasting, right? This is where the art comes into picture and more business decision comes into picture. Top-down analysis is you calculate the entire spectrum of the market, and from there you estimate that how much market you will be able to gain, and then you do a top down analysis. Bottom up analysis is, like for example, if you are a manufacturing unit, how many units you are able to produce. From there you build the model backwards, right? And then you have regression analysis, which is quite commonly used. It's a statistical technique, and with the use of Excel, it becomes very, very easy nowadays to use statistics till the time we understand the statistics. Okay, and then the last is year over year growth rate. So today's model or today's discussion is based on year-over-year growth rate, right? So these are forecasting methods basically. We have understood the complex and the simple methods of forecasting. And then you have certain auditing techniques to do in your model, which also we will see when as we move forward. Okay. So now these are all steps which we will be using for financial modeling. Okay. How do you copy paste and all that? When we will do, I think you will be able to follow me on these points, but has to be done very, very step-by-step approach. Okay. Now coming to, so when you have made the three statement model, now there may be a need. So you may be doing the three-step model for forecasting or budgeting, right? But there can be a need to use it in the business valuation also, right? Now, how do you do a business valuation is a question. Can you guys tell me what are the approaches in which a business valuation can be done? Price to earning ratio. PE ratio, okay. Yeah. What else? But how do you calculate earnings? Earning is your forecast. So you do it on 2 years down the line, or basically the terminal value. So you get the earning based on that, and you give a multiple of that. Yeah. That's right. And that is one of the method. What else? Enterprise value. Enterprise value. Enterprise value. Okay. Or for that matter, book value. But how do you calculate enterprise value? Enterprise value. Right. So that is what we are going to discuss. That what are the kind of valuations we have and where we are. So this is all the background to understand in this whole spectrum of valuation and financial modeling. Where are we when we discuss this today's topic, right? So Dhruv says NAV, DCF, transaction multiple, and trading multiple. Yes. Okay. So with this, we will move forward. How can you do valuations, right? You can do valuations by three different approaches. One is the cost approach. When you are acquiring an asset intensive company, right? An asset intensive company, you may do valuation based on cost to build. Let's say, for example, one company has built a blast furnace. Blast furnace is built by the steel companies, and it takes crores of rupees of investment to build a blast furnace. Okay. Now, if you are taking that piece of the business, and they have only one business, blast furnace, so you may take a cost approach that if you have to build that blast furnace from the scratch, what will be the cost to you? Accordingly, you will do a valuation for that, right? Or what is the replacement cost? Let's say the blast furnace is old, it is 3 or 4 years old. What is the replacement cost of that, right? So depending upon what you are valuing, your approach will change, right? Your approach will change, correct? Yeah, Sudha and Rahul, both you are right. Then you have a business valuation when you do and take market approach basically. So how do we do a valuation or say that this price is costly, this stock is cheaper, this stock is costly, is only by way of comparing it with other public companies which are trading, and we use a multiple which is price to earning ratio. What is the price and what is the per share earning of that share, right? So we compare P ratios and things like that, right? So you can do this market approach by using the publicly available information for the listed companies. You figure out which is the closest listed company to you, and you use that for your valuation purposes. Okay. Other is specific transaction. This is also a very popular approach. So you get these data that what has happened in the public space is available, but what has happened in the private space is not technically available to us, right? merger acquisitions which has happened in the private sector, you can get those data from the paid sources like Capital IQ and other websites, okay, from where you get the past precedent transactions, and which is closest to you. You will take it as a clue, basically. You will take it as a clue for your business, okay. And the third one is the discounted cash flow approach, which is also called as intrinsic value approach, where you do forecasted future cash flows, right? Now, you will ask which approach is the best. So there is no one answer which fits for all. You calculate. So normally when you do business valuation, you do calculation for all three type of methods and try to build one result for this. Today, I will build this model and show you the overall result. Okay. So with this, I will move forward. So we are where we are here today, right? We are doing this particular thing today, right? So with this, I come to an end of my PPT, right? Any questions? Should I move forward to my Excel sheet now? So before I move to the Excel sheet, I want you guys to get familiar with a couple of formulas and concepts. Dhruv, so look, for all the things, the valuations, the ratios which we are using will change significantly. Okay, if you are doing banking, then your ratio may be price to book value. But if you are doing a valuation of what um, a e-commerce company, then your ratio would be different. DCF can be applied to any kind of company. DCF is a standard approach where if your assumptions are right, you have to be very, very conscious about your assumptions actually in the DCF model, because everything gets changed if your assumptions gets changed, right? And I will just show you the scenario and sensitivity analysis, okay, and the outputs, comprehensive outputs also today, if the time permits. But our objective today is to learn few formulas, few concepts, and prepare a DCF. Getting my point?
Sir, I'm able to get your point, but I have a doubt. These research reports from the stockbroking or this various rating agencies, is it they do extensively follow this DCF, or do they have any other model?
No. So let us, Karthik, let us just wait. Okay, I will show you one output, and then you will realize that how a particular formula, as I said in my previous slide, that if you ask me which one is the best, I can't tell you.
Okay.
Because the valuation happens on beyond these numbers. Let's be brutally honest. Okay.
Okay.
We as an accountant can put our heart in the numbers, but the deal does not happen on numbers.
Yeah. Yes.
Right? The deal happens on lot of softer aspects.
Yes.
Like who is the promoter? Correct? Yeah. How much? Look, Jio is able to attract so much of investment.
Yeah.
Right? Why? Is it only because of the DCF?
No, it's something to do with the Indian market, Indian consumers.
Right? A lot of things plays into picture. So it is not one, but all these things are factored together to give you ranges, possible ranges, under possible circumstances. Okay. So when you do deal with valuations on the Excel sheet, you deal with ranges. Okay, and I will show you that. And when the deal actually happens, it happens on chemistry.
Okay.
Right? How Oyo is able to get so much of this thing.
Yeah.
Right? SoftBank likes that guy. Simple as that. Right?
Even they continuously burn cash, they still is attracted by that model.
Exactly. So all these startups are burning cashes and becoming unicorns. So do you think they are working on DCF model? DCF?
No.
Right? So it does not. So you know what I'm trying to say. A fine difference is that you will do valuation model with all the techniques which you are using, but your deal may or may not happen on those numbers because it is beyond the numbers which can be a game changer.
Okay.
Right? WeWorks, you take the example of WeWorks, right?
Yes.
From the valuation of $48 billion, right?
Yes.
Within a quarter, they were struggling at $10 billion.
Yeah.
And which model will support? WeWorks will do a better job, right? They were all exposed.
Yes.
Still, SoftBank Bank still funded them $10 billion. Why? Because it was beyond something, beyond numbers. That someday something will click, and someone has a belief in that.
Yes.
Right? So the real trade, the real transaction happens on something beyond the numbers, but numbers are also critical.
Okay.
Getting my point, Karthik?
Yes, sir.
So
yes, sir.
we have to. So when we are doing, so one thing which I want to mention here, when you want to do, and that's one problem which I see, okay, and I also have that problem, that we as finance professionals get so much into this Excel sheet, okay, in the accuracy of the Excel sheet, the linking of the Excel sheet, the numbers of the Excel sheet, that we stop looking at the wider pictures.
Okay.
Right? That business understanding.
Okay.
To question the assumption itself, how the business is going, what are the other factors? We stop reading ourselves. So when you want to become a good valuation professional, okay, it is important that you read a lot, that you understand businesses a lot, to understand what is happening in the world. Then only you will be able to bring out those finer aspects in your valuation reports, which will differentiate you from others. So understanding the business is the key for business valuations. Then comes all these tactics, statistics, scenarios, and all that. They are also very, very critical. Okay, right? But they are just a part of the entire exercise. Getting my point, Karthik?
Yes, sir. Yes.
Yeah. Mr. Piyush, I have a small doubt. Yeah, please.
Yeah, to understand the business, annual reports are, they give first-hand information, or we should see something else beyond.
Okay, Lakshmi, I got, so it's not an easy answer to give. Okay, so can you just prompt me again when I finish my session?
Yeah, sure.
Because we will digress, okay, what we are trying to achieve in this session. Right. It's a very, very important question. Let's take it up in the last, okay?
Yeah, sure, thank you.
Okay. Now, what is enterprise value? Can anyone tell me what is enterprise value? I don't want to go on the formula कि ये add करना है, ये less करना है is enterprise value. What is an enterprise value? Can anyone tell me? Just tell me in a layman's term. वो three idiots वाला definition में नहीं समझा. Asset value. Huh?
No.
Enterprise value is what? What is enterprise value? In a very layman term.
The economic value of the company.
नहीं यार ये समझ नहीं आता है. Economic value of the company मतलब क्या? Exactly. Who is this? Suraj. Right. So Suraj is right. Company का अगर मुझे
I'm sorry. Can you just translate what he said in English? I don't understand.
Okay. Who is there?
I'm Karthik.
Sorry.
I'm
so
sorry.
he
I
said,
don't know Hindi.
no problem. We are making it completely in English. But EV is the price which you will pay to buy the entire company. That's the EV. Getting my point? The price which you pay not only to shareholder, but the entire price which you pay to purchase the company altogether today. So it has two components, right? Rather three components. So let's see first two components, okay? So what is the formula of an EV? EV is what? EV is the value of equity, right? Reduced by the value of debt, right? that is your EV, basically enterprise value, correct? This is what you will have to pay for your completely acquiring the company. Getting my point? So let me just put it this way. Right? Enterprise value is your value of your equity plus the value of your net debt, because you will have to pay to both of them. Both are the stakeholders of your company, correct? Getting my point? Both are the stakeholders of your company. And what is net debt? Net debt is your debt minus whatever cash you have. Because what will happen is, if you are acquiring a company and there is some debt which you will have to pay, first what you will do, you will take that cash and pay for that debt. The balance only you will have to pay now, correct? And then you will have to pay to the equity holders. Getting my point? So your EV is equals to equity plus your net debt is your EV. Or you can put one more equation. I'm not going to minority interest right now. I will share this. Thing. Just let us build on the concept and then we will move on. Right? Equity plus debt minus cash. Right? This is your enterprise value. Okay? So we calculate here the enterprise value is enterprise value plus the debt which is here. So right now it is 0 and minus the cash. So since it does not have any capital structure, okay, it has a different, it has the same enterprise value because the asset value is also same, right? But let's say in this situation, if debt was 400, then your equity value would have been 9,600. So it is starting from enterprise value basically. So I will have to reverse the formula. So your debt, if you have a debt, you have enterprise value of 9,600. Let us take one more example. Equity is 100. Okay. Debt is 50. So what is my enterprise value? My enterprise value is this much, right? I'll take one more example where I have equity and then I have cash of, let's say, 20 rupees. Okay. So my enterprise value would be this plus my debt minus my cash. So 130 is my enterprise value, right? This is my EV. And if you have to calculate the equity value, you will have to do a reverse calculation, basically, right? So that's how your enterprise value is calculated. And lot of ratios are computed on enterprise value, right? When you do valuation, EV by EBITDA, EV by EBIT, all these are valuation metrics which are very commonly used. So it is important for us to understand what enterprise value means. Okay. Now enterprise value, you have all other things also, not only equity and debt and cash. These are very common. But if you have minority interest, preference shares, unfunded pension liability also will get added, okay, to equity, debt, net debt. You add the minority interest also if you have minority interest, because you will have to pay to them as well, right? So that is how you calculate the enterprise value, right? And from enterprise value, you may do a reverse engineering of the formula and come to the equity value, like how we are doing it here, right? Getting my point? Am I clear? Like here, if you calculate your equity value from enterprise value minus your debt, right? And here it will be what? Enterprise value minus your debt plus the cash, right? So that will become your enterprise value, right? So with this, we will move out of the definition of enterprise value. Okay, I will cover two more formulas which will become important as we move to our calculation. Okay, as we move to our calculation. Yeah. So how many of you are able to calculate IRR and NPV?
Yeah, I can do it in Excel.
You can do it. How do you do it?
Giving the like using Excel formulas, giving the like inputs like initial investments and the cash flow.
So what is the formula you will use, Suraj? Is there any formula you will use, or you will do it through a table?
I will do it by table.
You will do it by table. So let us do that. Okay, let us do that. We will. So what we will do is we will learn few formulas, 3-4 formulas, and then we will go to our main exercise. Okay. Now let us do Suraj ways of doing it. Okay. Now I have this question where I will have to calculate the net present value of these cash flows. Okay. Now you see, just ignore the dates for first exercise. Let's assume they all are 31st December 2016. Let's assume this is the date, 31st December 2016. Okay. So that means all are yearly cash flows. So what I will do, I will plot the cash flows, correct? For which year? Let's say end of year 1, 2, 3, 4, 5. Right?
Change of screen.
Oh, I'm so sorry. I'm so sorry. I'm so sorry. Thanks for prompting. Yeah. So you see, this is the question which we have, that how do you calculate the NPV from this file? Okay. So you see the cash flows are given year wise at the end of, all are end of. Okay. End of 1, 2, 3, 4, 5. Okay. And you have dates also given in. So you see all are yearly, but the first one is somewhere in between. Okay. But let us do a cash flow assuming that it was also 2016 for the first question. Okay. So let us see this way so that it is easy. Rather than fixing and all, I will just put it this way. Right? And what is the cash flow I have? I have this cash flow. Right? Right? This is the cash flow which I am having from this particular exercise. Now, what is my discounting factor? My discounting factor for the end of first year would be this minus this divided by 1 plus F4, right? This will be my first year discounting factor. My second year discounting factor would be 1 plus right? These are my discounting factors. And if I multiply my discounting factors with this, what I will get? I will get a discounted cash flow. Net present value of these cash flows discounted at 10%. I think with the interest, I think we have done it a lot, right? Now you see these were end of the year. Now, if I have to make it 17/8/2017, would it become complex, right? So I can do the same thing here by calculating or using a formula called NPV. If I put NPV and don't do anything, I will is equals to NPV. And you see, it asks you for the first argument as rate and the second is your range. Okay, so you got the same numbers here. By just using the NPV function, you can get your output. Okay, so you technically don't have to do the table, Suraj, right? You can get away with all these tables and can use the formula which is NPV. But now you have the dates also. How do you do that? Your tables becomes more and more complex when you go through this kind of working. So what we do, we use NPV as the formula. XNPV as the formula, right? And the date we will put, values we will put, right? And we will put the dates in the argument, okay? And it will calculate the net present value taking dates into account, okay? Taking dates into account, basically. So even if it is fraction of the year, it will take that particular thing. Like here it is 36/2020, okay? So it has considered that. The formula is smart enough that it has considered that. You may make a table, Suraj and others, to get to understanding of this formula, how it works. So this is a formula of XNPV, which is a very good formula to choose, right? Like that you calculate IRR, right? Internal rate of return, correct? So for this also you have a formula of XIRR, right? Which has values and the dates. Because rate anyways you don't have to give the argument. So it gives you the IRR taking the dates into account. Otherwise your IRR formula, your normal IRR formula considers each thing as a year and gives you an answer. So your normal IRR formula gives 18% as an answer, because for him, for this formula, each is end of the year. So it takes 5 end of years. But this IRR formula does not take into consideration the dates in which the cash flow comes to you. XIRR formula takes that thing into account. Getting my point? Are you guys with me? Any questions? Sorry, your voice is not clear. Who is speaking? Ajaz. Yeah. So is it clear? Should we move forward, guys? And on our main IRR once again. Look, IRR में क्या होता है? Who is there? Ajaz. Ajaz, if I take IRR, okay, IRR में what it takes is year 1, end of year 1, end of year 2. It takes end of, okay? It takes a complete year, but here, and it takes all that as one, okay? So this cash flow, it is taking in the 5 years period, and hence the IRR is 18%, okay? But you see, the first is only August, September, October, November, December, 5 months, right? And the last is only 6 months. So how to tackle that? So what you do, either you will have to calculate the interest rate, basically for that fraction of the period, and then calculate the discounted cash flow, right? Otherwise, what you do, you put it under XIRR, which takes dates also into consideration. So each parallel date, it takes the cash flow, okay, and compute a IRR for you, right? It takes into consideration against each period, basically. Getting my point? This becomes your XIRR function. And when you do your this thing, financial modeling, or nowadays when this leases and Ind AS is coming into picture, I think these formulas, I have lot of others which I covered, like MIRR, MPT, IMPT, to calculate the EMIs, etc. Okay, but these two formulas are basically very, very relevant for us for today's model which we are going to build. Okay, are you guys with me? Should I move forward? Yeah, thank you, thank you, thank you. Okay, great. Now what we will do? Now we will go to our main sheet. Okay, our main working, and we will improvise on that working. Okay, so let me just open the main file. Basically, to move to that file, till now we have just created the background. Okay, I will open the file. Now you see, if you remember that triangle, guys, I told you that the first step, so that you must be having all these files, no? This file number is 413, Sudha. So you must be having that. So look at this now. This model, just try to absorb. Just try to absorb the model right now. Don't worry on the file as of now. Try to understand the concept. Okay, and then we will see if I can help you with the files for others who have joined only for today. So you see, this is a 3-step projection which has been prepared. Okay, the first is the financial statements, historical financial statements. Okay, from 13, 14, 15, 16, 17, 5 years. And then this file has projection for 5 years data. Okay, now you see, let's calm down. It says balance sheet matched. It's just a formula. You all do this. Okay, then you have assumptions. If you remember, assumptions are very important, right? So all these black numbers, what does black number denotes, guys? What does black number denotes in a financial model? And it's not a rule. Okay, it's not a rule. It is what? Formula. It is formula which we have created by discipline. ठीक है? ऐसा कोई रूल नहीं है कि फाइनेंशियल मॉडल में ब्लैक कलर का ही आप ब्लू को फॉर्मूला बोल सकते हो, ब्लैक को हार्ड पंचिंग बोल सकते हो, whatever. Okay, but what we have discussed is, look at this, all our formulas, right? All our formulas here. So these are actual numbers, these are actual growths for these 4 years, right? These are actual COGS to revenue ratio. These are actual salary to revenue ratio, rent, overhead, depreciation, interest ratio, right? Tax ratio, accounts receivable ratio, to project our account receivable, right? Inventory ratios, right? Capital expenditure, this is an absolute numbers, okay? And see, so clearly it is written here, number of days, thousands, equity share, etc. So what we will have to do, we will have to take the historical data and do all the calculation basically. So you have it here, and you see all these are coming in from bottom, right? All these are coming in from bottom. All are formula linked. Okay, so this we have done as a part of preparation of 3 financial statements, which is balance sheet, P&L, and the cash flow. But today's objective is not to prepare that, but to go to the next step. So assume you have got is prepared as a first step, okay, because they are independent. Now what blue color denotes is you have got all the projections that revenue growth will happen at 10%. Your GP margin would be so much. Your salary and benefits will be 17%. Rent overhead will be fixed at 15,000. Then depreciation is X percentage. Inventory days is 18 days, right? So now look what historical data is helping you as a financial analyst, that you have some reasonability. Okay, inventory days have been 73 days. I am projecting 80, 90 days, 100 days. It is increasing. There may be some reason. Let me understand, right? Here, account receivable dates are flat at 18 days, right? So it gives you a indication that these ratios are in the right direction. Like for example, tax is 31%. You have projected 28% tax, right? So like that, logically you should see it, but don't go into too much of depth of it. While building the financial model, keep notes to ask business that why you believe so, right? You have all right to ask, but first is let's build the model, and in scenario analysis you can do everything possible. Okay, so you see now revenue you have built the gross profit, salary, everything. Through these ratios, you can make entire P&L, right? You made entire P&L, you made entire balance sheet, okay? And you made entire your cash flow statement, right? This is also, you need to learn to build this entire by having certain assumptions in place, okay? And these are the schedules also, which you prepare as a working schedule. So if you remember that 7-step which I discussed on the PPT are these 7 steps basically, right? So step by step it has told you what needs to be done at what point, okay? Now come to our main portion where what we are going to discuss today, and we will see how we are going to present our output, okay? Now when you do DCF, right, the first thing which you need is what? For DCF, what is the most important thing? For DCF, what is the most important thing?
The discount rate, what we are assuming.
Discount rate, growth projection, okay. What else? The most important thing is what? The first step is what? The cash flow itself, right? You would need the series of cash flow, as Naresh has rightly pointed out, right? You need a series of cash flow, right? Now you see, now let us understand this case study. So this is a case study, very close and very akin to the real life case study, okay? Because in all my classes I try to take very close to real life case study, okay? Now the tax rate, so this is a assumption which has been given for discounted cash flow, okay, that you are going to enter into this company on 31st of March 2018 is what your transaction date is, okay? And now this is the projection which has been given to you. You are trying to analyze whether it is worth making the investment in this company basis the kind of growth this company is going to have, right? So the first step is what? The transaction date. So the transaction date is given, and since it is blue color, that means it is hard punch number. These assumptions are given to us in the question, okay? And I will take all the questions which you have, how we calculate assumptions and all, but let us take assumptions as assumptions right now, okay? Now you see the tax rate has been given, the discount rate has been given as 12%, perpetual growth rate, because when you do discounted cash flow, even in your FM and all that, you must have seen that you will calculate for 5 years and then you say this will grow perpetually for 5% or 4%. This is perpetual growth rate, okay? Then EV by EBITDA multiple. So what is EV by EBITDA? I told you we calculated EV, enterprise value we have calculated. Equity plus net debt is your enterprise value into 8 times. is the valuation multiple for this. How did you get this? Maybe the shares which are trading on the stock exchange are trading at 8 times EBITDA. So that's the most appropriate assumption to take, right? It can be 7x, it can be 9x, it can be 10x, right? But I will cover that up once I build the DCF model. Okay. Then financial year ending. What is the financial year of the company? Is 31st December 2018. Means it is a December ending company. Current share price is 16 and shares outstanding are 20,000. Okay. So now what we will do, we will calculate the discounted cash flow first, right? Now you see how much is this time period? Basically, this 2018, how much is this time period? This is not a complete year basically. It's a fraction of year. So how much fraction of year it is? There is a formula called as year fraction. Year fraction, and you give the year fraction to this particular thing, right? You give year fraction this and year fraction, you give the start date and you give the end date. So it will calculate the fraction of the year. So it is what 9 by 12. So it has calculated fraction of the year. For others also we will do fraction of the year calculation. So it has become this is the exit. So there will be no year fraction. So we will just put it as 1 right now because it is the same thing, you know. This is exit and 2022. So exit is also, we are assuming that you will exit from this investment, okay, on 31st March 2022, right? So we calculated year fraction. Now let us calculate. Now what is that we will have to calculate? My ratio is on EBITDA. My multiple is on EBITDA. That means earning before interest, tax, depreciation. Correct? So I will have to calculate my EBITDA, my cash flow, which is unlevered cash flow. That means it has nothing, no adjustment for depreciation. It has no adjustment for interest payment. Okay. So how I will calculate my EBITDA from the given information? I think all of you can calculate that. How much EBITDA you have for 2018 is, we will go to the profit and loss account, up, right? So earning before tax plus interest. So I have to calculate earning before interest and tax, right? So this becomes my EBITDA. If I copy this to the balance portion, I will get the EBITDA for everything, correct? The last one I will not consider because it's not a year. The year is still here. It is only exit. So I will only have terminal value in this column, right? Then you have what? Cash taxes, right? So how much is the cash taxes you will have to pay, right? That you will calculate. Okay. So what is my tax which is given to me in the question? Is 12%. I'll make it a fix F4. Okay. We will calculate the taxes. Okay. Net operating profit after taxes, how much? After taxes, how much? I will do a simple calculation here. Okay. I will do a simple calculation which will give me net profit, right? After tax. Then what I will do? I will have to plot depreciation and amortization, right? From where I will get depreciation and amortization? I will get it from my P&L, correct? So I will go to my P&L again, and either I can take it from cash flow also, but for maintaining consistency, I will do it from my P&L, right? So this I have got the depreciation for the first year, correct? And what I will do, since it is linked very, very properly, there is no hidden column, etc. in the entire working. So my life is actually easy because I can just take it at one go. Now, how do I calculate EBITDA? Earning before interest, tax, and depreciation. So I will again go to the P&L. Okay. So earning before tax and earning before interest and before depreciation. I will add up all these three things. I will get my EBITDA number, correct? I will get my EBITDA number here, correct? Now, what is my capex? I will have to do my capex calculation. From where I will get how much capex I have done. So I can get my capex figures from either the cash flow or the most appropriate place to get the capex number or the capex projection is your cash flow. That is where you get expenditure which are done in the capex. Also, your cash flows will be dependent on what? Your cash flow will be dependent on the changes in the working capital, right? This is your projection. Your changes in the working capital will also impact your cash flows, which you can get it from your cash flow projection. Okay, your cash flow working. Let us go there, and can you get it directly? You in this cash flow you have direct changes in working capital, right? Which are like negative changes, right? In the working capital for that means your current assets are increasing in these 4 years, and your current liability is increasing in this year. So you have a benefit. Now you calculate unlevered cash flow. What is unlevered cash flow? Net profit after tax plus you will add depreciation minus your capex and your changes in net working capital, right? This is what you have got. That is what I was explaining, Pawan, that changes in working capital, okay, is an increase of your you see, it is actually an increase in your current asset. If you go here, it is less in the cash flow, it is less changes in working capital. If you see the formula, your working capital is getting subtracted. So that means in these 3 years, your current asset is increasing, your debtors is increasing, right? Because of which you have to pump your cash in the current assets. Hence, it's causing your cash flows to decrease. Getting my point, Pawan? In this year, the negative means what? Negative means your liability is increasing. In this example, okay, the way you can link it in your file is different. But in this example, positive means increase of current assets because in the formula, we are subtracting it. Getting my point, Pawan? Yeah. So what we have done, we have got to a place where we have got the cash flows for 4 years, 5 years, right? Now what we will do is transition cash flow. Means look, this 24,000 cash flow is for entire year. So I have to take only pro rata cash flow, right? For 0.75, but for others it will be same, correct? Now what I will have to do is that can I calculate the enterprise value now? Okay, I will have to calculate the enterprise value, the terminal value of the enterprise. Okay, so let me just so terminal value, perpetual growth rate, I will have to calculate, then calculate the enterprise value basically. So let me see